Good morning and welcome to the Mortgage Rate Forecast with Scott Criss. It is June 16th. Holy cow. Holy guacamole. Look at this, guys. Mortgage-backed securities opened great today. Some crazy trading yesterday. We're trading at $103.13 this morning. This is the best since January of 2015. This is pretty big, guys. Look at this. Look at this trading. Look at these charts. You can see this upward trading channel. Look at this huge gap right here from early June. So here's what we got. New supports coming in below us at about 103. As you can see, we are trading right in the middle of this trading range, and our resistance is coming in at 103.44. How the heck did I pull out 103.44 resistance? Well, I had to go back in the charts all the way back to January of 15, and that was the last high that we hit that is available on these charts. And so we're actually breaking some pretty crazy ground here, guys. So really good news. We got to be a little cautious though. Investors don't want to explore new areas unless they're really being forced to. Okay, it's uncomfortable. And just kind of think of us as human beings. When we're uncomfortable with things, we don't really like to do things. And so investors are the same way. If it's going to be really tough for us to really go above 103.44. So here's the scoop. Jobless claims came out, helped us. Worse than expected, definitely much higher unemployment requests came in. Some of that could be due to teaching, but California was a big component of that. So not so pretty for the economy, but definitely jobless claims was helpful for bonds. Philly Fed came out, housing came out. None of those helped us. But you know what really had a major impact is Yellen. Now, we all knew that Yellen was going to come out and say, hey, we're not going to increase the short-term rate. At least if we didn't know, we were pretty darn sure she wasn't going to increase it. And the proof was in the pudding. She came out yesterday, said, no, we're not only going to not increase it, but we're also going to tone back on what we believe the economic growth to be. So all of that was actually very bond friendly, and that's a big reason why that and the UK. You probably heard in the news UK may be pulling out of the union, and so that's going to create questionable trading. And so what do investors do when they have their money? They're like, okay, they can put it in stocks. Stocks are more risky, but they're going to get better returns on their stocks. Or they can put it in bonds. Bonds, they don't make much money in bonds, but it's a little bit safer there. At least they kind of have a better idea of what the returns are going to be. So with everything going on with the UK, with the Yellen coming out and saying, hey, we're kind of toning down our forecast for economic growth in the United States. Well, the investors are like, where do we put our money? High risk or flight to safety? Boom. Bonds. So that's where we're at. And that's why we're seeing a lot of these gains. So we could see this rally and actually go higher. We're definitely maintaining this upward trading channel that you see here. So anyway, let's just keep a close eye on it. Like I said, even if we continue to rally up, 103.44 is going to be a tough ceiling to break through. So here's what we got to quantify. Freddie Mac, as you can see down here, the source reported the average rate to be 3.6 at 0.6 points here last month. That was average trading about $102.40. Now we're trading at $103.13. That's 76 cents better. That means if we take Freddie Mac's report and we apply what we know about the bond market, that means if we're trading 76 cents better, we could actually get a 3.6 rate, pretty close to a 3.6 rate with perhaps no points. So those are the averages being projected right now. Anyway, let's get to the forecast. Now, we're a little inconsistent with our analysts on the short term. And you know what? I should have put inconsistent here. Sorry about that, guys. But short term, 1 to 2 days out. And some analysts are going a little neutral with that. Some analysts are going bullish. So inconsistency there with the analysts. Inconsistency in the long term as well, what they're forecasting for the next 30 plus days. One of the more conservative analysts is going bearish, and the other analyst is a little bit more neutral in his stance. So lots of inconsistencies there. And let me go back here real quick. Bonds from my last report slightly did exceed my expectations, so they did do better than I thought they would, and so not by a lot, but still they did beat my range. So here's what I'm forecasting until the next report on Tuesday. I think bonds are going to trade between 103, 103.25. I don't think we're going to see any major gains, but maybe some slight ones up through next Tuesday. If you have if you have a loan that's in process right now and you're considering doing a 30-day lock, a lot of people ask me, hey, Scott, what would you do? And dude, nobody has a crystal ball. Nobody can say, oh, definitely do this and you're going to win 100% of the time. So, but taking all of this stuff into consideration, if you're doing a loan and you have an opportunity to do a 30-day lock, you may want to consider taking these gains and locking in that loan and just patting yourself on the back and saying, hey, I'm really happy with this. So anyway, that's it for now. Let us know what you think. Let us know what you think mortgage-backed securities are going to do, what interest rates are going to do. Are they going to get better? Are they going to get worse? And what are your thoughts on that? Also, hey, I want to hear from you guys. If you have like an idea for future videos, one of my subscribers is like, hey, tell us, if you think it's a good idea to lock. And so if you have an idea, something that you would like me to add to the agenda, let us know. Leave your comments down below. And if it's your first time on the channel, doesn't hurt to subscribe. If you hit that subscribe button at the top left, that'll just get you a little quick reminder when we release updates. And if none of this makes sense to you, it's okay. At the top right here, this little guy scratching his head, you can click him. That'll take you to Mortgage Bonds 101, give you the fundamentals that you should know as a consumer if you're thinking about getting a mortgage. And this will show you why these charts are important, why these reports are important, because the impact to you as a consumer is really, really huge. Anyway, that's it for now. Please like the video before you go, and we'll see you next Tuesday. Bye, guys.